Personal finance and financial literacy are all about understanding your money and how to best use it. And once you attain a decent level of financial literacy, so that you can make sound financial decisions, you can then take the next step to building your wealth. This, of course, requires much more than just understanding financial concepts. To become rich, one must have a sound investment strategy, be able to take risks, and have a bit of luck. While there is no guarantee that just anyone will become rich, those who are financially literate stand a better chance of achieving this goal. Overall, financial literacy is critical for managing your money effectively. It encompasses a wide range of topics, including budgeting, saving, investing, and managing credit. By understanding the rules of money and key financial concepts, you can make sound financial decisions that will benefit you in the long run. This will then allow you to be more proactive in managing your finances. It's really something that should be taught in schools, so that people can learn the basic concepts of personal finance and how to manage their money. Unfortunately, it isn't given the emphasis it deserves, even though it's a life skill that everyone should know about. While different people may have differing views, broadly speaking, there are 4 key building blocks that are essential for understanding and managing your finances. In this video, we'll discuss what those building blocks are, and how you can use them to become financially literate. Building block number 1. Understanding basic financial concepts. The first item you should look at are basic financial concepts and terms. Think of these as the language of finance. As with any topic in life, if you don't know the language, you're gonna find it pretty difficult to learn. While there are hundreds of different financial concepts out there, we'll start with just 4 critical ones. Concept number 1. Interest. Interest is simply money that is paid to someone when they lend their cash or any other asset. When you deposit your money in a bank, you're really lending it to the bank. In return, they pay a certain interest rate. Of course, the reverse is true when you borrow from a bank. As you can see, interest can be both your friend and your enemy, so it's something that is important to pay close attention to. Concept number 2. Inflation. This typically refers to the phenomenon of prices going up, for a variety of everyday goods and services, such as food or groceries, or gas, or electricity. When talking about inflation, you may have seen the term CPI, which stands for Consumer Price Index. Inflation simply reduces your purchasing power, especially if your income isn't going up as quickly as prices of goods and services are. In a high inflation or a high CPI environment, this can be pretty painful on your wallet, and it's a good idea to keep a tight rein on your expenses. Concept number 3. Assets and liabilities. The best way to understand assets and liabilities is this. Assets are generally things of value you own that will earn money for you, either by paying you some income, or by selling it and getting cash. A liability is the opposite. It's something that you need to pay for regularly, or pay a lump sum to get rid of. For example, real estate would be an asset, since you can either earn rental income from it, or sell it for cash, whereas a loan would be a liability, since it's something you need to pay regularly for. Concept number 4. Liquidity. Being able to pay for things when you need to is the basic definition of liquidity. Not having liquidity doesn't necessarily mean that you don't have money or resources, but it could just be a result of your money being tied up in things like real estate, or other asset types that aren't easy to cash out on. Having enough liquidity is critical to ensuring that you don't get caught out by unexpected events, which is where tools like emergency funds come in. Let's move on to building block number 2, creating a budget. Many people avoid budgeting for fear of being deprived. They feel that they'll be starved of things they love if they stick to a budget. However, it's the unfortunate truth that life will never get easier if you don't commit to a budget. In fact, it'll get harder. Over time, most people find they're actually able to have some wiggle room in their budgets, and can add new things, or increase spending in other areas. A budget is a vital tool to help you save and spend smartly. If you stick to your budget, you'll have a much better idea of where your money is going to each month, and how much you have available to spend and save. That can help you fight the temptation to overspend, or pay too little attention to important spending areas. Before you can start budgeting, you need to track your current spending. For at least a month, or preferably a couple of months, write down every single expense, including taxes and insurance payments for items that don't appear on a monthly bill, such as car repairs. Eventually, you'll have a good idea of your average spending in different categories. That will help you create a realistic budget that has enough room for saving and important, regular expenses. Budgets are extremely important, as they can help you save for big expenses and goals, such as car repairs, retirement, and big purchases like a home. A budget can also prevent you from overspending on unnecessary items. Everyone likes to have fancy coffee or a pricey meal now and again, but if this type of spending becomes too frequent or gets out of control, it will interfere with your ability to reach your financial goals. Before we get to the third building block, go ahead and hit that like or subscribe button if you found this video useful so far. And now building block number 3, managing your debt. If you want to be financially free, you need to have a solid understanding of credit and how it can impact your financial situation. Credit can be a helpful tool if used correctly, but it can also lead to bad debt and financial problems if you're not careful. That's why it's so important to learn about credit and understand how it works before you start using it. Once you have a good grasp of credit, you can use it to your advantage and either minimize it or use it to build wealth. There are many different kinds of debt, including mortgage loans, car loans, credit cards, student loans, personal loans, and business loans. Though all types of debts have similar traits, that is, you owe someone money that must be repaid with interest and fees, the amount you can borrow and the reasons for borrowing may vary by type of debt. For this reason, debt can sometimes be classified into so-called good debt and bad debt. In summary, good debt is debt that is used to finance something that will generate gains for you in future. This could be to finance an investment property, which could give you rental income and hopefully some profit when you decide to sell it in future. Bad debt is debt that is used just to finance consumption, or things that you don't really need. Credit card debt is one of the usual culprits here, since they are usually used for nice-to-have items, rather than really important things. For this reason, not all debt is bad. The wealthy often use debt to help them make even more money, by using it in the right way. This could be to buy assets that they feel will generate some solid returns, or to optimize their tax returns. Check out this video if you're interested in finding out more. Building block number 4. Investing for the future. Investing is a powerful tool that allows you to prepare for future needs. This could range from purchasing a house, to starting a business, or for retirement. Because these future needs can be significant, it's important to get started on the process of saving and investing as soon as possible. In its most basic form, saving simply means putting money away and not spending it. However, for most people, this in itself isn't a good long-term strategy. If most of your money is just sitting in a bank account, you are likely to spend it on something sooner or later. Or the value of that money will slowly be lost through inflation. Instead, you should set up an automatic transfer to put money away each month towards investing, to meet your long-term goals. Now let's talk a bit about investing. Stocks and bonds are two common types of investments that can help you earn a return on your money. But there are also other options like real estate, mutual funds, and exchange-traded funds. Each of these has its own advantages and disadvantages, and may be suitable for different goals and time horizons, so it's important to do your research and understand what might be right for you. One thing that is important to understand when investing for the future is that there is some risk involved. No one can guarantee any investment will grow, or that you will receive a specific return. But with the right knowledge and a little bit of planning, you can make smart choices with your money that will help you reach your financial goals. Of course, when researching investing, it is important to find reliable sources of information too, as there is a lot of misinformation out there. This is especially true when it comes to wealth-building strategies. There are many so-called gurus who claim to have the secret to becoming a millionaire overnight, but the reality is that wealth takes time and patience to build. By getting your research from reliable sources, you can avoid losing money in fraudulent investments. Check out this video next for more tips on financial literacy.